IAS 16, Property, Plant and Equipment. For FRK 300 purposes, we will be focusing on the tax implications of specifically the revaluation of land. Everything else in IAS 16 you have already done in FRK 201, and for cost model IAS 16 assets, we have already looked at that during our IAS 12 lectures. So for this one lecture in IAS 16, there's only two things that you need to learn and that you need to walk away with. The first thing is that that you should realize is that deferred tax on revalued land will be calculated using the capital gains tax rate. In FRK 300, we will revalue land to an amount above the original cost price. Now, this rule comes from paragraph 51 in IAS 12, which says that the measurement of deferred tax liabilities and deferred tax assets shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover the carrying amount of the asset. Then paragraph 51b says that this measurement of this deferred tax liability or deferred tax asset shall reflect the tax consequences of recovering the carrying amount of any non-depreciable assets through sale when that non-depreciable asset is measured using the revaluation model in IAS 16. So up to now, when we did our calculation for deferred tax for land, we had our carrying amount for land, and then we would say, okay, we are going to use that land in future to make taxable, get taxable economic benefits. Therefore, the tax base will be the amount that will be deductible in future. And then we said, okay, that is 0. And that gave us then a temporary difference, which, remember, we said should be exempt because it arose at initial recognition. And it was not a business combination, and at the time of recognition did not affect accounting or tax profit. So up until now, all the assets we had, including land, we were always saying, okay, we calculate the tax base based on the idea that we are going to use these assets. Now paragraph 51b tells us that the moment we have a non-depreciable asset, so that is our land, measured using the revaluation model, then we have to calculate the tax base as if we are going to recover that asset through sale, not through use, but through sale. And then paragraph 51b also says that sometimes the tax law specifies a tax rate that will be applicable to this taxable amount derived from the sale of the asset that will be different from the normal tax rate. And in South Africa, we have that, and that is the capital gains tax. So, first thing, deferred tax should be calculated on revalued land, should be calculated using the capital gains tax rate. The normal rule is that we use the tax rate that is based on how the asset will be recovered, and that could be either use or sale. And usually what we do with all our assets, we say we are going to use them. So we calculate the tax base based on the fact that we are going to use these assets in future. But IAS 12 tells us that when we have land, non-depreciable asset, that has been revalued, then we have to calculate the tax base as if we are going to recover that asset through sale. Thus, the revalued land, we assume that it will be recovered through sale at the revalued carrying amount, and that will give us capital gains tax that we will pay on the capital gain, and we will also use the capital gains tax rate for deferred tax. Okay, so therefore what happens is, what's going to happen now is we are going to have our carrying amount of land will now consist of my original cost as well as the portion that has been revalued, giving me then the carrying amount of 120. Now, because we are assuming that we are going to recover this land through sale, the tax base will be the amount that will be deductible in future. And in this case, the 100 Rand original cost will be deductible in future when we sell this asset, giving us then the temporary difference of 20. So that's the difference between our selling price, if we were to sell this asset at the revalued amount, less the base cost, which is our tax base, giving us then a taxable temporary difference, and that is going to give us deferred tax, but it's going to give us deferred tax at the capital gains tax rate. Okay, the second thing that you should realize from this video is that we have to show the tax consequences of the revaluation in OCI. So paragraph 61A tells us that current tax and deferred tax shall be recognized outside profit or loss if the tax relates to items that are recognized in the same or a different period outside profit or loss. Therefore, current tax and deferred tax that relate to items that are recognized in the same or a different period in OCI shall also be recognized in OCI. So the tax follows the transaction. If we have a transaction that will affect equity, the tax effect will also be recognized in equity. This will not be applicable for FRK 300. We will only have this situation where we have OCI items, specifically the revaluation of land. Okay, so the revaluation surplus will go to OCI, therefore the tax consequences should also be reflected in OCI. Okay, so on the date of the revaluation, we will account for the deferred tax through OCI. So what's going to happen when we do our revaluation, and usually that will be at the beginning of the year, we will increase the value of land with the revalued amount. And then we will accrue for the deferred tax on that. We'll create the taxable temporary difference in deferred tax, and that will be at the capital gains tax rate. Okay. Okay. So here we are, and note the different line items. So our revaluation surplus goes through OCI, so that's the gross revaluation. And then we say, okay, but remember, we actually want the net amount is going to go into equity, so we have to account for the tax on that as well. So that also goes to OCI, and we call that account the revaluation surplus deferred tax account. So these two amounts, the credit over here and the debit that we have over here together will give me the net amount that goes to equity at the end of the year. Okay, when in our statement of profit or loss and other comprehensive income, you'll see that for other comprehensive income, we will have the revaluation surplus on property, plant and equipment. And here we will have our gross amount of the revaluation less the income tax expense, giving me the net amount that will go to equity. Okay, so that is how we disclose it in OCI. When it now goes into equity, when it goes into my statement of changes in equity, into my reval surplus column in my statement of changes in equity, it will lie there now the net amount after tax amount. When we sell that asset in future, it is going to go, we have to move that revaluation surplus to our retained earnings. And when we do that, that will also happen at the net amount. So the tax consequences are only accounted for on the date that we do the revaluation through this journal. Okay, so what has happened up to now is we have said that in our deferred tax calc, so there's my deferred tax GL account in the SFP, we say that we leave our opening balance, the balance from the previous year, we leave that balance in there. We do our deferred tax calc, and at the end of the year, we calculate what we want our closing balance to be. And then we go and we do a journal for whatever it is that we need to go into that deferred tax account to get to the closing balance. And this journal, the other leg of this journal, will go to my income tax expense. However, now when we get to the revaluation of an asset, what's going to happen now is we are now actually going to do another journal to this account. So we still have our opening balance. Then when we do the revaluation at the beginning of the year, we are going to, like we said, we're going to debit the asset with the revaluation, credit the revaluation surplus in OCI, and then we are going to go and debit the revaluation surplus deferred tax in OCI and credit our deferred tax account. So here we now have an additional journal that's going to go in here. So this will be, the other leg will be the reval surplus deferred tax OCI account will be the other leg. So instead of now taking it to, here we took the movement to P&L, and we're still going to have a movement to P&L. However, the tax portion of the revaluation surplus, that other leg goes to OCI. Okay, so what's going to happen during the year is we are going to, first of all, we are going to have our opening balance. Then we are going to do our revaluation and get a journal into this account. Then at the end of the year, we calculate what our closing balance should be. And when we do this, the last thing we can do is to see what is the amount that needs to go to P&L. So that is what our deferred tax SFP account will look like. Okay, so this is just the introduction to IAS 16. In our lecture, we will be looking at it in more detail.